Nitin Bhasin, Head Institutional Equities at Ambit. Nitin, great to have you on the show. Thank you so much. And always a pleasure chatting with you. All right, let's start with, frankly, the biggest talking point right now is the corporate numbers. Budget is at one go. I think Trump is in, the background, but it's the corporate numbers. And I'm keen to know your view. Are you seeing a big fundamental problem here or a blip?
Good question. If you look at the September quarter's numbers, they're clearly a shocker because the number of downgrades that we saw in the September quarter was pretty much very high. There was issues around consumption, issues around margin pressure because of the rising input prices. And I think going into the December quarter, our expectation was that downgrades perhaps will be there, but perhaps not to the acute extent of what you saw in the September quarter. So I'm expecting that there will be some more downgrades, but more so in the mid caps and the small caps, and hence that should be washed out for. So we are perhaps after 4 years of good earnings into a little bit of a weak patch, which can extend anything between, I would say, 2 quarters to 4 or 5 quarters or so before we form a view that this pressure is over and now investments either from the government or from the companies, corporates, is leading for them for an acceleration again. But I wouldn't be surprised that we see 1, 2 more quarters of earnings downgrades and more pressure on the earnings. The present quarter numbers don't give a very good sign yet because it's just about a week, 10 days. IT, the three heavyweights, marginally surprised. Kotak was good. But beyond that, I think what we expect of Nifty sales is panning out the way we thought. But after that, we are yet to see numbers to show, which gives us some trend right now. So I would say in a downgrade cycle, let's watch out for the well-balanced numbers to come.
Interesting point that you're making with that earnings is slowing down. What is the impact that you're expected to see then in terms of Nifty 50 earnings this year? Because then it seems that 2025 as calendar year is not really going to be easy going for equity markets. And probably we will barely manage to touch that low double-digit gain kind of a number.
So, if you look at India's last 14 or 15 years of earnings trajectory, we at sell side perhaps started with a lot of optimism and we used to go through downgrades. But post-COVID, the scene was pretty different. And we've seen either the last 3 or 4 financial years, either earnings were upgraded or they held to the starting estimates. In this particular year, which is FY25, we're expecting not more than, I would say, as of right now, closer to about 8% of earnings growth. When you started the year 12 months back, perhaps we're all closer to 14, 15%. So I doubt if this 8% number also stands true. We might be closer to 7% or 6.5%, 7% earnings growth for this year, which is very muted after reasonably holding earnings well for the last 4 years. Next year, the consensus is building closer to 15% earnings growth. There could be some more downgrades into that. So we are in a weak earnings environment, as I was speaking earlier. So which means that there will be pressure on stock market returns. And for the last 1 month, 3 months, what we have been highlighting to our institutional investors in the asset allocation, you got to be in more large caps, you got to be more in IT, you got to be more in banks. These are the sectors where we see less pressure on earnings downgrades compared to the mid caps and the small caps. So hence, you would have a very different trajectory of earnings downgrades amongst mid cap, large cap versus amongst mid caps and small caps versus the large caps.
Nitin, thought comes to mind, I'm sure in some of those conversations that you just talked about, there would be also a reassessment of returns, of Nifty returns as well as, equity returns that your clients could expect. What are you telling them? Give us a glimpse of what those conversations are going like. And is it a bit about managing expectations right now?
I think, the last month and a half or 2 months has been very rapid, especially in the mid cap and the small cap. After 9 years, we are seeing some sort of a after 9 years, we are seeing some sort of a starting point of the year being so weak. What we are telling investors is expect CY25 to be very low return market, stock picker market, and more importantly, it's the mega caps within the Nifty that could actually be outperforming. You can see that in the last month also, Nifty may be down about 2%, and banks and IT index will be down 4%. But we've already seen about 7-8% declines in mid cap and small cap index. That's what we are highlighting, that this year you may make muted returns, but asset allocation will help you outperform the market if you are staying in large caps or mega cap companies. That's the sort of conversation. And what of sectors that you choose where earnings downgrade risks are lesser? That's for the clients that what we are indicating to them.
So Nitin, the key thing that everyone focused on was the way the capex spending from the government has panned out in the first half. There was slowdown. Now, the number that comes in terms of the budget is key, and how their allocation changes. Probably that will help you understand if there is any shift that would be happening in terms of the markets. What is your expectation, taking into consideration the expectations your investors have?
Well, we all want that the country should be actually either from the government or from the corporates witness an increased investment momentum, because that is a multiplier effect for both jobs, consumption, near term as well as in long term. But I think all of us are focusing on what will they spend. The question that we have raised yesterday in our budget note is what are we trying to do to solve our revenue sources? Because if you see, our revenue sources define how do we spend money. I think there's a lot of room if you compare ourselves to the EMs. We all take a lot of confidence in how post-COVID our tax collection improved. But that improved for one time, about 80 or 100 pips. Otherwise, we are sort of stuck between 8.8% to 9.2% of GDP in our tax collection. How that number changes or accelerates will be the key, because that just gives government a lot more muscle power, or let's say money to spend in capex. How I'm looking at this year, I think we would like to hear that the government announces 15 to 20% increase in roads, perhaps 15 to 20% increase in railways, and even on the same lines goes out and thinks about how to give money for PLI. Because the amount of money that we are thought to give for PLI, on the fourth year also, we are way, way behind. Not even 10% of the disbursals have happened, what they had planned for PLI. So I would say road, railways, and incentives for real hard, large capex on new industries like renewables or EMS is what I would be looking out for in the budget in terms of capex. But more importantly, what are we trying to do to solve our revenue sources, because that will define in the long term our capability to spend continuously rather than in a very, let's say, frugal manner. So this year, there has been a slowdown after 4 years on government's capex. We haven't yet seen October, November, December numbers looking up. How do they talk about capacity building, project identification? Those have to be watched out for. So that are my thoughts on the budget in terms of it's the revenue that we need to solve more. It's the capacity that we have to solve for to handle that large sums of money. We need to now put FY25 behind because we have underinvested in capex, but we have to look forward.
We have to look forward. I think everyone's desperately trying to look forward, but you need clarity on what is, in that view that you can see. Nitin, but thank you so much for joining us. Always a pleasure to chat. Nitin Bhasin, Head Institutional Equities at Ambit there, talking about what you expect from the budget or what he is expecting from the budget. And our focus on budget is big right here on NDTV Profit.